As the end of the year approaches, many people start thinking about holiday plans, but savvy taxpayers are also thinking about strategies to lower their taxable income before December 31st. With the IRS deadline looming, proactive planning can lead to substantial tax savings. Fortunately, you don't have to be a financial wizard to take advantage of easy methods that legally reduce your taxable income. Whether you're a salaried employee, self-employed, or an investor, understanding available deductions, credits, and contributions can make a real difference. By making smart financial moves before the calendar flips to 2026, you can save money, avoid unnecessary tax burdens, and position yourself for a more financially secure future. Here are the top 10 easy ways to lower your taxable income before the year ends. 1. Max out your retirement contributions. One of the most effective and straightforward ways to reduce your taxable income is by maximizing contributions to your retirement accounts. If you have a traditional 401k, you can contribute up to $23,000 in 2025, or $30,500 if you're 50 or older. These contributions reduce your taxable wages, lowering your income and, consequently, your tax bill. Similarly, traditional IRAs allow contributions of up to $7,000, $8,000 if you're over 50, and those may be tax deductible depending on your income level and whether you or your spouse are covered by a workplace retirement plan. Even self-employed individuals can contribute to SEP IRAs or solo 401ks, offering more opportunities for deductions. Act now. These contributions must be made before the end of the tax year to count. 2. Contribute to a health savings account, HSA. If you're enrolled in a high-deductible health plan, HDHP, contributing to a health savings account, HSA, is a triple tax-advantaged move. Contributions are tax-deductible, earnings grow tax-free, and withdrawals for qualified medical expenses are also tax-free. In 2025, individuals can contribute up to $4,150 and families up to $8,300, with an additional $1,000 catch-up for those 55 or older. Not only do these contributions reduce your taxable income, but they also build a financial cushion for future medical costs. Funds roll over year to year and can even serve as a supplemental retirement account. Contributions must be made before year-end to count for the 2025 tax year, so this is a timely action to take. 3. Take advantage of flexible spending accounts, FSAs. If your employer offers a flexible spending account, FSA, you can lower your taxable income by contributing pre-tax dollars to cover qualified healthcare or dependent care expenses. For 2025, the healthcare FSA contribution limit is $3,200, and up to $5,000 can be set aside for dependent care. The funds must be used by year-end or within a short grace period, depending on your plan, so it's important to plan spending carefully. These accounts can be used for doctor visits, prescriptions, childcare, and eldercare expenses. By using FSAs, you reduce your taxable income and effectively get a discount on your out-of-pocket costs for necessary expenses, making it one of the easiest year-end tax-saving strategies. 4. Donate to qualified charities. Charitable contributions are not only a great way to give back, they can also lower your taxable income when itemized. Donating cash, appreciated stock, or even property to IRS-qualified 501(c)(3) organizations can provide significant deductions. For cash donations in 2025, you can typically deduct up to 60% of your adjusted gross income, AGI, while non-cash donations have varying limits based on their value and type. Make sure to keep receipts or acknowledgement letters for donations over $250. And ensure the charity is IRS approved. Donating before December 31st allows you to claim the deduction on your 2025 return. Batching donations, combining 2 years' worth of giving into one, can also help if you don't usually itemize. 5. Harvest tax losses in your investment portfolio. Tax loss harvesting is a smart move for investors with underperforming assets. If you sell investments at a loss, you can offset capital gains from profitable assets, reducing your overall tax burden. Even if you don't have gains, you can deduct up to $3,000 of capital losses against your ordinary income per year, with the remainder carried forward to future years. This strategy is especially valuable during volatile market years. Just be aware of the wash sale rule, which prohibits you from claiming a loss if you repurchase the same or a substantially identical security within 30 days. Strategic selling before year-end can help you turn market downturns into tax advantages. 6. Make your January mortgage payment in December. Homeowners who itemize deductions can reduce their taxable income by prepaying certain deductible expenses, like mortgage interest. If you make your January mortgage payment in December, the interest included in that payment can be deducted in the current tax year. This trick works especially well if you're close to the standard deduction threshold and want to bunch deductions. Be sure to check with your lender to confirm how early payments are credited, and confirm with your tax advisor if this tactic fits your overall tax strategy. While small, this timing-based move can provide a meaningful deduction when added to others like property taxes or charitable giving. 7. Defer income into 2026. If you're self-employed, a freelancer, or work on commission, consider delaying invoicing clients or receiving year-end bonuses until January 2026. This effectively pushes that income into the next tax year, reducing your 2025 taxable income. This strategy is especially useful if you anticipate being in a lower tax bracket next year or if you're close to entering a higher bracket this year. Keep in mind that deferring income may not always be wise, especially if you expect increased tax rates or a windfall in 2026. Still, when used strategically, this simple timing adjustment can offer big savings. Just be sure to balance it with your cash flow needs. 8. Invest in municipal bonds. If you're looking for a longer-term strategy that also pays off in the short term, municipal bonds can be an excellent option. Interest earned from municipal bonds is generally exempt from federal income taxes, and if issued in your home state, they may also be free from state and local taxes. Investing in municipal bonds late in the year still allows you to take advantage of tax-free interest income on your 2025 return. These low-risk bonds are particularly attractive to high-income earners seeking to reduce taxable income without reducing investment earnings. With rising interest rates, new municipal bonds may offer more attractive yields, increasing both tax efficiency and total return. 9. Utilize the qualified business income deduction. Business owners, freelancers, and independent contractors may qualify for the qualified business income (QBI) deduction, allowing up to 20% of eligible income to be deducted from their taxes. The QBI deduction applies to sole proprietorships, partnerships, S-corporations, and certain LLCs. While income limits and business-type restrictions apply, those who qualify can significantly lower their taxable income. Before year-end, review your earnings and expenses to ensure maximum eligibility. You may also consider contributing to a retirement plan like a SEP-IRA or deferring income to stay under the income threshold. This deduction is one of the most powerful ways to reduce tax liability legally and easily before the year closes. 10. Pay deductible expenses in advance. Another easy tactic to lower your taxable income is to prepay certain deductible expenses before December 31st. These might include property taxes, student loan interest, medical expenses, if they exceed 7.5% of your AGI, or business-related costs. For example, prepaying tuition or subscriptions can help small business owners reduce profits and taxes. If you expect to itemize deductions, this strategy is especially useful. Keep in mind that the IRS requires you to actually make the payment in 2025, simply scheduling it is not enough. When done correctly, this timing trick can help you claim more deductions this year and lower your overall tax liability. As 2025 winds down, taking action now can help you significantly reduce your taxable income and set yourself up for a better financial start in the new year. From maxing out retirement contributions and leveraging health accounts to harvesting investment losses and strategically timing income and deductions, each of these methods is both legal and relatively simple to execute. While some require a bit of planning and coordination, others, like charitable giving or early mortgage payments, can be done quickly. Don't wait until the last week of December to think about your tax strategy. Consult with a tax advisor to ensure you're taking advantage of all available opportunities tailored to your situation. The earlier you act, the more control you have over your tax outcome, and the more money you'll potentially keep in your pocket when April comes around.